Hi, this is Linda Hitt. This clip is going to be about receivables, accounts receivable, notes receivable, and receivable from credit card companies. All resources are assets of the company. Our main focus will be on accounts receivable. We'll discuss a little bit about notes receivable and receivable from credit card company. Accounts receivable is a short-term customer promise to pay money, usually arising from a sales revenue or service revenue. Sometimes we allow time discount, sometimes not. But normally there's no interest charge. It's 30 days, end of the month, or something pretty short. And if you don't pay, the customer doesn't pay on time, there may be a late fee. Notes receivable can come about as two basic ways. Trade notes receivable is a customer notes receivable. Either we sell something expensive and we help to finance it, or we have an accounts receivable that the customer cannot pay off and we negotiate with them a notes receivable to extend the terms. The other possibility is we're simply lending someone money like an employee or a vendor. This is usually interest bearing, and it can be like a 30-day note, or it could be a 5-year note. So we'll deal with interest calculations, and we'll look at it, the interest calculation, looking at the time. It could be so many days over 360 days, the business year, or 365 days. Or it could be, again, a 2-year note, 5-year note, or something like that. Because we recognize receivables before we collect them, under accrual accounting, if we record a revenue if we think it's reasonably certain that we'll get the cash. Obviously, we realize up front that we are not going to collect all the cash on all accounts receivables. We don't back out the revenue if we don't get the cash, but what we later have to recognize is a cost or expense of this, which we usually call bad debt expense, or uncollectible accounts expense, or doubtful accounts expense. You know how accountants are, we can't do it in one way. It's difficult to time the bad debts because the revenue is recorded and it takes us a while to finally give up on a customer. So seeing that it can take as many as 6 months, if we just simply waited till the customer didn't pay us, the bad debt expense could be in a different accounting period than the revenue that it goes with. So because of matching concept, timing expenses to fit into the same period as the revenue, we have to often estimate bad debts. We have to come up with something before we actually know who isn't going to pay us. Conservatism is another concept we're using, where accounts receivable is going to be recorded at less than 100%. The net realizable value is actually what we think we're going to collect, so if you have a choice of two different values for an asset, we're picking the lower of the two. Estimating bad debts, no mean feat. Fortunately for you, percentages and so forth is provided, but the allowance approach has two ways of getting there. The income statement approach, we express it as a percentage of all revenues earned on account. So, if you're looking at a 1-year period of time, that's 12 months worth of revenue where we have an accounts receivable, and so it's going to be a relatively small percentage that we estimate that we will not collect. And this probably is the easiest way because we're looking at the big picture, where the balance sheet approach focuses in on the ending balance in accounts receivable at the time you do your statements. We're trying to project the net realizable value, which is what we think we're going to collect. So one of the problems with this method, we may have to go through an aging where we look at all the accounts receivable in the subsidiary ledgers and determine which ones are past due, which ones are not, and project percentages. But when we do the actual adjusting entry, which this bad debt estimate would be, with this approach, we're going to have to deal with beginning balances and something called the allowance for bad debts. Allowance for bad debt is a contra asset account, and we'll see this when we do our example in a minute. Where with the income statement approach, our focus is on bad debt expense. Bad debt expense never has a beginning balance because we close the books and we get rid of the temporary accounts. So definitely the balance sheet approach often is a little bit more complicated. In your text, direct write-off method is mentioned, but it's not going to be the recommended choice because it violates matching and conservatism. It just doesn't time things in the right time period. It shows accounts receivable at 100%. However, there are times where we probably have to do this. Small companies with very few accounts receivables probably will do this. It's not easy to estimate bad debts when you have very few accounts receivable. Or if you go through the process of using the allowance approach and you use either the income statement or balance sheet approach, and you don't get anywhere close to the estimate compared to the actual, then you may just simply do this because for lack of something better. Certainly keeping up with receivables, granting credit, determining who you're going to give credit to, determining terms, sending out letters afterward when people don't pay, turning it over to a collection agency. All the follow-up can certainly cost a lot of money. You've got to have staff to do this, and it's a process. Your other option is to not run your own accounts receivable system and not have your billing, but let somebody else do it, in which case you might allow your customers to use certain credit cards, Visa, MasterCard, or whatever, but you give up a percentage of your revenues, 3%, 4%, 5%, depending on whatever the bank, the credit card company expects. However, this may still be a better option. Receivables from credit card company, the benefit of this, which we just kind of ended with on the last slide, unless the credit card company goes under, hopefully they won't, we get cash pretty quickly from them. So it's maybe a couple business days after, or maybe, with pretty quick turnaround time. And we sort of pass our worry on to them. So if the customer doesn't pay, it's their problem, not our problem. Of course, we do give up a percentage of our revenues to do this, but it may well be worth it not to have to deal with it. So it certainly is an option that we have. And we have a new account called credit card expense, which is that 2%, 3%, 5% that we're giving up, which is being recognized. Okay, let's go ahead and take a look at our example. We're going to go do the usual. We're going to do the general journal entries, take a look at how the statements are affected, and then we're also going to do the best we can. I may not be able to pull this off, but we're going to look at the subsidiary ledger for accounts receivable, individual customers, and then we'll also look at notes receivable. Okay. I didn't have it at the top. So here's our general ledgers over here. Again, what I'd like to do at the end is possibly just deal with the new accounts that we have and kind of give you just a quick idea with Post-it notes as to where these accounts fall. We may or may not deal with numbers depending on how the numbers go. So the first thing that happens to us is we recognize service revenue on account. On account, if you remember, if you're dealing with customers, accounts receivable would be used here in the journal. General journal, we can be summarized. We can do the total. And I just picked service revenue so we wouldn't have to deal with cost of goods sold with sales. Kind of shortens it a little bit. So if we recognize revenue on account, we'll see our assets going up because of accounts receivable. I always do this. And we see service revenue is retained earnings account, it's a temporary account. So with closings, retained earnings goes up, stockholders' equity. And the income, of course, we have more profits if we have revenues, so that's going to go up. And there's no cash flow. Okay, then at the end of the period, the accounts receivable would be posted to the general ledger. Software posts it, of course, right away, which is the nice thing about software. And then down here we have service revenue. And then the certainly would be a headache in a manual system is posting to the subsidiary ledger. So we have all these customers, JK, and it's of course a debit in the journals. It's a debit in the subsidiary. So I'm going to use the T accounts this time for the subsidiary ledger. Though we've used different paper in some of the other clips. So because it's a debit, again, these are all debits. So we have a whole bunch of different customers, JK, JC, TC. We weren't too creative here with the names, but I didn't want to spend an hour typing them, so we'll keep it short. So all of these get posted. And again, with things like software, all that, we enter a customer number, I guess. or name, and it would be updated. Whoops. Okay, so I think, hopefully, wait, 1, 2, 3, 4, 5, 6, 7, 8. Oops. I've got 1, 2, 3, 4, and then I kind of skipped a few there. The joys of a manual system. Okay, so I've got 500, and we're going to use these later, otherwise I wouldn't put you through this. But we will talk about write-offs and so forth, and hopefully it will help you understand that better. At least that's the hope. Okay, so I've got CB 1000 and AC. CB 1000 and AC was, I think, 3. Yeah, AC's 3. Okay, hopefully I got them all in there, but who knows. Okay, a lot of detail in the subsidiary ledgers. Okay, but I think we did it, hopefully. And then in the second entry, we're actually collecting cash. So again, in the journals, we've done this entry before. We're simply cash, one asset goes up, the other asset comes down. And again, we don't need it to do a separate entry for each customer. We can summarize it and kind of lump it together for that day's transactions. And so this is really an asset exchange. One asset goes up, the other asset comes down, so I could leave that blank or show plus and minus. As far as cash flow goes, there's more cash, and it would be labeled as operating. It's from a customer. So there's not a huge impact here with the collection, but we're very happy to get the cash. As far as the general ledger, we now see our cash going up and accounts receivable coming down. Like I say, we'll do the best we can with this. And then JK gave us the money. JC gave us the money. So these people are becoming zero in their balances. DC gave us money. And CB. That's also 1000. Okay, so hopefully we got that right. And so those accounts actually show a zero balance if we were to total it up. Okay, hopefully that's it for that one. One of our customers couldn't pay, so we negotiated a short-term note with interest. And so this, what we want to do here is replace accounts receivable with notes receivable. So we're going to debit notes receivable to increase it, credit accounts receivable, and it's $1,500. The interest we don't deal with until time passes. So either the note's collected or the end of the accounting period comes, we need to recognize interest revenue for it. Okay, we don't have to round any interest. I'm going to take that off. I don't know why you put that there. Oops. Oh. A little too quick on what I did. We don't have to deal with interest until time it does pass. So if you look at this, we have one asset going up, the other asset comes down. So it is an asset exchange. No impact on the profits yet, and no cash. What it does do for me is I need to set up notes receivable for $1,500, and somewhere here I have it. I put a cash at the bottom because that's not our major focus, and I wanted to put the accounts that we use the most frequently at the top, so it's not exactly in the order that you might see it. But I'm going to take TC out of accounts receivable and move TC to notes receivable, and then the also a subsidiary ledger. So I'm going to cancel out this one. I'm going to write here to notes receivable because it's different. It's not a collection. And then down here we have a notes receivable. Didn't allow any title for the room for the name, so I'll just put TC here. What the heck? And the balance for the note is $1,500. Okay, so it comes out of there, goes into notes receivable, and comes out of accounts receivable. So we got the subsidiaries going, general ledger, and hopefully so far so good. Okay, number 4 was our first setback. LH did not pay. That's actually my initials. I'm a deadbeat customer here. And so we wrote that person off. Now you'll notice we haven't estimated bad debts yet. That's okay. Whenever it happens, we write off. And the write-off entry is kind of an interesting one. We have a new account called Allowance for Bad Debts. It's a contra asset. When you do the write-off, you're going to reduce the contra asset. So I'm going to actually debit it. Contra accounts have the opposite balance. So assets have debit balances. Contra assets actually have credit balances. But to get rid of it or to reduce it, in the write-off is what I'm doing, I'm reducing it, that I have to actually debit it. And then the credit will be to accounts receivable. So this is when we have an actual person, name, face, address, where the person's unable to pay. You've gone through your 3 to 6 months of your normal process to make the collection. Now it feels like this should make a huge impact on the statements, but if you take a look at what it does to the statements, if you're reducing accounts receivable, I think we'd all agree that's reducing assets. But if you reduce a contra asset, you're actually increasing assets. Two negatives make a positive. So it turns out to be an asset exchange with very little impact on the balance sheet, no impact on the income statement, and no impact on cash flow. So it's not a big changer here in terms of the numbers. If we post it to the general ledger, go ahead and probably should do the subsidiary first, but I'll do this. The allowance account has got a debit balance, which is really an abnormal balance, but we know it doesn't matter because before I do statements, I'll do my adjusting entry and I'll estimate bad debts. And then over here, we're going to reduce accounts receivable. And what's really important is we go to the subsidiary ledger. It's a credit in the general journal, it's a credit in the subsidiary, and I'm going to put written off. I'll have it documented in that one place. That person didn't pay, and I probably won't grant them credit for a certain period of time. Okay, so now we go on and we collected the TC note. Okay, TC was up here. 60 days have passed very quickly. Time does seem like that sometimes. And we need to collect the note. So normally you'd have like cash and accounts receivable like this entry. We're going to use cash and notes receivable. And then the other piece, of course, is we actually have the benefit of a 2% return on the 60 days. So the titles are going to be cash going up, notes receivable being taken off, and the interest is going to be set up as interest revenue. It's all fitting into the same accounting period, the note being taken out as well as the collection. So all of it is earned and collected in the same time period. So we will need to look at a calculation, which I'm sure you all will do fine with. And it basically goes like this. And maybe I should use a new sticky note. I like these sticky notes, they're fun. Oops, didn't do what I wanted it to do. New note, that's because I didn't click the right place. Well, what do you expect, right? But the calculation for interest is principal times interest rate times time. Interest rate is usually annual, and time again is how long we held the note. So principal is $1,500. The interest rate that we charged was actually relatively low. I guess we're trying to be nice as customer. Maybe it's a very good customer. 2%. That was just the numbers I made up. And it's a 60-day note. So we've held it for 60 days. So the time is 60 days divided by 360, which is the business year, or sometimes you'll see it as 365. So it depends on whatever the bank is doing. So that's what we're trying to calculate. Now this will probably all disappear, but anyway, so if you can keep that in mind, 1,500, oh it doesn't, okay, times 0.02 times 60 divided by 360, and it comes out to $5. Okay, so now if I can get rid of all these Post-it notes, maybe not. I guess I can just close. Okay. Whoops, I think I took care of them permanently. Okay, so interest revenue is 5. Notes receivable we set up there was 15, so we're going to take that off. I should be crediting it. And so the cash that I'm collecting is the principal and the interest, which is $1505. Okay, so that's again new for this chapter. And what's the impact of collecting a note? Well, there's a lot of stuff going on here. There's two different assets. So cash, the asset, is going up. Notes receivable, the asset, is going down. And you can see that it nets to $5. Interest revenue is a retained earnings account, so retained earnings will go up by 5. And so the assets go up by 5 and the stockholders' equity goes up by 5. So you're balancing the balance sheet. And then the income, profit and loss on your income statement, you have more profit by $5. And the cash, this particular notes receivable is a customer notes receivable. So it's called a trade notes receivable, and therefore it is really considered operating. Where if you just simply lend money to somebody, that's going to be investing. So the return and the principal on this one is operating. So I'm going to put plus 1505, and I'll put a big O for operating. Okay, so we've done the impact, and over here we can see that our cash, of course, is going up. We gained a little bit of extra because of the waiting 60 days. The notes receivable is now coming off the books, and we have a new account interest revenue, which down here is being picked up for 5. This does affect the subsidiary because we should have a subsidiary ledger for the notes receivable, particularly if we have more than one note, which we will probably have later. So notes receivable here is taken off, and so we know that TC has paid us in full. Okay, a lot of stuff, to keep up with, but I think hopefully we did it all. Okay, next we're going to loan money to a supplier, just to show you another way of getting a notes receivable. Again, don't worry about the interest until there's been passage of time, either as an adjusting entry or if the note matures in the same accounting period. And then we want to, I always do this. This should be notes receivable. We have an asset, notes receivable, and we actually reduce cash. I spent too long on the other side of the books here with notes payable. Okay, so that's what it looks like if we loan money to somebody. Two different assets involved. One asset goes up, the other asset comes down, so it is an asset exchange. No impact on the rest of the balance sheet. Nothing yet for the income statement until you have some earnings, some interest. And then last but not least, we have cash going out for $1,500, and this would be investing. Okay, because it's not a customer this time. We're actually loaning money to the supplier. And so we have cash going out by $3,000 in the general ledger, and we have another notes receivable for $3,000. And the subsidiaries we don't have to worry about. Oh, yes, we do. Every time I think we don't, we do. So I'm going to put super company. If I didn't have a title, I don't think I saw it. So we have a notes receivable with that of $3,000. Okay, so we're done with that, hopefully. Next, we're going to a customer that we wrote off back on March 20th actually came back, and probably doesn't happen very often, but we should know how to handle it if it does. So LH, which is me, I return, feeling bad about not paying, and now I'm actually paying on account. So now you don't want to turn the customer away just because you wrote them off. So there's two things that you want to do. You reinstate them, which is 7A, and then you collect. Because right now, I don't look too good over here in the subsidiary. I've been documented, I've been written off, that I didn't pay, so it's not a really good thing for me if I want to come back and buy something later. So what you basically do is reverse the write-off. If you look at the write-off up here, we debited the allowance, credited accounts receivable. So now we're going to flip it. And we're going to debit accounts receivable to put me back into the subsidiary ledger. The only way to do this is to do it in the journals first. So there's a reversing of the write-off, or the reinstate, however you want to call it. And of course it was an asset exchange up here, so guess what? It's also an asset exchange here. We're simply flipping. No impact on the income statement or cash flow. But what it does do is it puts me back into business again. So I'm going to take off the written off. I'm going to put myself back in as 500. So I'm reinstated, and then back over here in the general ledger, I'm going to be put back in as 500, and it comes out of the allowance. So you can see it, the debit and the credit to the allowance now makes that 0. And then step 2, do what you usually do when you have a customer come in to pay you. Cash and accounts receivable. And this, of course, is also an asset exchange. One asset up, the other down. No impact on the income statement. And for cash flow, we have cash coming in. And it's good news. It's from a customer, so it's operations. So I'm going to increase my cash for 500. Allow a big T for cash with a lot more transactions there, and also a lot more of this material also with accounts receivable. Okay, so you can see we have a debit credit which offsets, and then we finally see a good news, which is a credit. The original debit of 500 is included in the 19. Okay, so I was reinstated, and when we did the collection, the 500 would come out, and it would all be documented that I may have showed that I was written off, but it will show the reinstatement. Okay. Then we performed some services. This time we decided to try an outside credit card company. So if you remember, what we originally had was with a sale, we usually would have accounts receivable. And I'm going to leave a space just for a minute, and service revenue. That would be if it had been our billing system, but this isn't our billing system. So what we're going to actually pick up is receivable. A different receivable, but similar. Receivable from credit card company. You can put the name of the company, whatever. And the deal is, you're not going to send in a check or, online bill pay to pay the 5% charge for this service. They're just not going to give you less money when they send you the cash. So we have a new account called credit card expense. And so that's going to be a compound entry. And let me show you first as percentages so you can sort of get the idea. The credit card expense is 5%. I may not be able to do that. I tried that a minute ago and it worked fine, of course. I'll do it this way. That's a percentage. Just pretend for a minute that it's a percentage. So if you have 5% as a credit card, then your service revenue should be 100%, and 100% minus 5% means that you'll collect 95%. So if we were looking at just percentages, that's kind of the idea. Obviously we don't debit credit percentages, so let us go ahead and do the numbers like we should. And 8,000, times 5%. is 400. Okay, so the credit card expense is 4. The 8,000 times 95%, we expect to receive 7,600. So we're willing to give up $400 just not to have the hassle of dealing with the collections and bad debts and so forth. Okay, so that's what the entry looks like. It's just got the credit card expense there because you won't get the full amount. Well, how that impacts the statements. You have an asset going up for $7,600. I'm going to use the numbers on this one since it's a compound entry. So you have an asset going up, and then you have 2 retained earnings accounts. Service revenue causes retained earnings to go up. Credit card expense causes retained earnings to come down. And retained earnings is over here under stockholders' equity. So if you net them together, you can see that our retained earnings will also go up by $7,600, balancing the balance sheet. The profits, You have more revenues than expenses. So the difference, again, will affect your profit. You're better off by service revenue minus the credit card expense, and there's no cash yet. This time, we don't have to worry about a subsidiary ledger because this is not our problem. We don't have to collect it. So they have their subsidiaries, the bank or whoever deals with the credit card. But we do have a journal entry, of course. And I don't know if I ever set up receivable from credit card company. Don't see it. So look, I'm going to add it right now. And it doesn't matter if it's not in the same order. I'm just going to cut and paste, hopefully. Credit card, whoops, credit card receivable. That's close enough. And we're going to enter the 7,600. Okay, I don't know how I didn't remember to leave a space for it, but anyway, I didn't. So we have receivable from credit card company. I did have credit card expense, which is right there for 400. And then, of course, the revenue is 8,000. Yeah, so I'm going to pick service revenue there. Okay, again, no other subsidiary ledgers. Okay, and then on the 25th, we collected 8,000 from this credit card. Again, it should be pretty quick, a couple of days, couple of business days. So, and actually, that's a mistake, isn't it? We didn't collect 8,000, we collect 7,600. If I can get that right. I should have just said collected on credit card. And then we'll do our receivable from credit card company. But we should have a separate one, not call it accounts receivable. Okay, again, that's an asset exchange. Cash goes up, credit card receivable goes down. No impact on the income statement because we had the impact when we had the sale. And now the cash is finally flowing, so our cash is going to go up. And of course it's from a customer, so it has to be operations. So over here, hopefully I've been keeping this up to date. Cash goes up, credit card receivable, which I added down here, goes down, and it's 0. So it's all collected. Okay, and I guess that's good, hopefully. Okay, so now we're at the end of the period. That's hard to imagine. You're probably saying, thank goodness. Accrue interest on the supplier note. The one note we collected, which was good news, but the supplier note is the one that's from Super Supply Company. I think it's right up here. Loan $3,000 to Super Company, our supplier. So it's a 1-year 4% note. Notice it was April 31st. So we're looking at 6-month periods. The first half of the year is we're going to do a statement. The second half we're going to do another. So it's every 6 months. So we've held the note for May and for June. So just for 2 months. So let's do our calculation for this. And since we put up the sticky note before, we won't worry about the sticky note. I think I deleted it anyway. So this time it's going to be principal of 3,000 times 0.04. Again, all interest rates are considered annual unless you're told otherwise. But we haven't held the loan, we haven't held that note for 12 months. So we only held it for 2 months. So we're going to go 2 months, whoops, not like that, times 2 months divided by 12 months. 12 again because it's an annual interest rate. So we got $20, which is not a whole lot, but we'll pick it up. Okay, so this is an accrued revenue, which means that we've earned something, we haven't collected it, it's not been recorded before. So instead of accounts receivable, we're going to use interest receivable. And on the credit side, we're using interest revenue. They sound very much like the same title, but they're not, as we'll see here in a minute. So how do they impact the statements as an accrued revenue? We know that the assets are going up because of interest receivable. It's a permanent account, and it'll stay on there until you collect it from the holder of the note, or the holder, but the one who issued the note. And interest revenue is retained earnings, so stockholders' equity also goes up. So that's a revenue account. Again, it's very different. Your profits are going to be higher by $20 because of this, and that's why you're doing the adjusting entry, putting it in the right time period. And usually when you get to adjusting entries, there is no cash, unless you're handling a bank reconciliation entry. Okay, subsidiaries we don't have to worry about, thank goodness. So we have interest revenue for 20 as a credit, interest receivable for 20 as well. Okay, so I think we've updated that. And then the next adjustment has to do with trying to project the bad debts. This is the allowance approach. This is also using the income statement method, where we focus in on the income statement. So you'll see it says 10% of service revenue on account. So we don't worry about the credit card company. We're only talking about our accounts receivable. Our service revenue. Okay, so up here we sort of summarized the whole year just so we wouldn't be going nuts with all the different entries. So for the entire year we recognized $19,000 of our revenue on our own billing system. So all we have to do is take $19,000 of the revenue, I think I got the right number, times, I think I have 10%. Okay, $1,900 is the amount that we're going to deal with. And then the entry, interesting one. It's kind of like assets used up becomes an expense, and we haven't really used up an asset, but we certainly have a lower value for our asset because we know we're not going to collect the whole thing. So we deal with some type of expense, either bad debt expense, if you like softer language, it can be uncollectible accounts expense or doubtful accounts expense. And then the other side, glad that popped up, is the allowance for bad debts. Okay, so this is the one that has the impact, the adjusting entry. The write-off entry we saw a minute ago up here, wherever it is, didn't have much of an impact. Oh well. There it is. This one, the actual write-off, is when you know a name and a face and an amount, and you can see it virtually did nothing to the statements, except it did change the subsidiary ledger. It showed, that whoever wasn't paying was written off. So now what we're dealing with, how does this affect the statements? If you increase or recognize a contra asset, you're reducing assets. So the allowance for doubtful accounts causes the assets to go down. Bad debt expense is a retained earnings account. It's a temporary, and therefore it's part of stockholders' equity. In closing, so stockholders' equity goes down. Expenses always reduce profits, and there's no cash flow. So it does make a major statement where the write-off entry did very little. But here we don't know names and faces. It's just a percentage. And again, we're using the income statement approach. Okay, and of course I didn't make the entries. Did I do the $20? I think I did. Okay, so let me do the bad debt expense, $1,900. And the allowance for bad debts is up here somewhere. 1,900, not 19,000, 1,900. Okay, so I think we've updated that. So now we're in the second 6 months, and we're at least halfway through. So hang in there a little bit longer. Perform services on account. So it was no surprise. Accounts receivable and service revenue. I'm glad it recognized those accounts. And again, summarize, we can pick up the 30,000. And 30,000. I guess there's not enough space there, interestingly enough. Okay, we've done this before. I'm not going to deal with the impact because you already got that documented with the earlier entry. So let's post it to the general ledger. Accounts receivable, that's 30, so we have 30. Hopefully I'm keeping up with that, but who knows? I think I am, maybe. And revenue, 30. Okay, And then you do the usual posting to a subsidiary. So I cut down on some of the activity here so you weren't going to be overwhelmed with more postings. So JC is 10. I think I'll use the same customers maybe. Okay, JC is 10, and they paid off their account before, so we were happy to grant them credit again. And then if we do the others, we've got TC for 8. Okay, that person also paid us, so that's nice. And 2 more, bear with me. And I was granted credit because I came back and paid my bill. So I charged 1,000. And JK, which is Jane, she had a big charge of 11,000. And she paid her bills. Okay, so I think we got everybody, but again, who knows? Okay, so we've got that, and then we go on to, from last year we collected from BH. So we got cash, and we've done this entry before, so I won't worry about the impact. Cash is going to go up, and accounts receivable is going to go down. So this was for 3,000. I'm sorry, 2,000. So 2,000 accounts receivable goes down, and cash for 2,000 goes up. Okay, and BH needs to be posted too. So in the subsidiary ledger, BH had, there he is, or she, a 0 balance. Actually, that's my spouse, so I'd have to say he. Okay, and I forgot to put the amounts in. That's funny, I got everything else in. Okay, so we collected, we wrote off for AC. Remember the write-off entry, very little going on. We got the allowance account, the contra asset, and accounts receivable is going down in the write-off. So we have a name, a face, and so this is kind of bad news. This is kind of a large write-off. We only projected, I think, 1,900 for bad debts. So our estimate didn't come out to be so good after all. So I'm not going to look at the impact. We've done that. It's just a plus and minus under the assets. Very little change. But it does impact the subsidiary. So we'll go to AC. I'll put in the 3,000, and I'll put some kind of language to know that they did not pay us. They were written off. And that will affect their future credit with us. Let's see, and we also need to do the general ledger. So accounts receivable is going to go down by 3, and the allowance goes down by 3 as well. Okay, next we collected some money, which is always good news. And I'm going to pick up the 18,000 here, and then I'm going to post only 2 people paid me, JC and TC. So JC is there, and TC is here. And that 2 notes receivable actually goes with the first entry, so I'm just going to take it out so we don't get confused. Okay, so those are up to date. And I did the cash. No, accounts receivable went down by 18. I didn't do that, and I need to do the cash. Okay, so I've got that, and cash, wherever it is here, right there. Okay, I'm not sure we're going to do all the totals, but anyway, I thought we'd at least demonstrate that. Credit card sales. Okay, so now you've just decided at this point in time in the year that you're going to accept credit card sales, other companies, other credit cards from other companies. So, well, actually we did that once, did we not? We decided actually up here at the end of that period that we were going to accept credit cards. So, I'm going to lift that. I come over here and just simply stick those titles in because they're the same titles, and we'll do the math. $15,000 of credit cards, and it's the rate for these, the rate changed to 6%. Okay, things always go up, don't they? So we've got $900 here. The service revenue, remember, the revenue is always recorded at the full amount. I didn't allow space in there, did I? I'll have to add a little room. So we have $15,000 for the service revenue, and then if we take 15,000 times the 95%, that's what we're going to be receiving, $14,250. Okay, so again, our journal entry should balance, and then I got to add some space here, because then we turned around and collected it, and I didn't leave any place to do that. Let me see if I can just insert it. Okay, so in the collection, which really should have been here, I won't worry about the color. We collected the credit card sales, so it's cash and receivable from credit card company. And of course, again, we give up part of our cash in order to let somebody else deal with the collections and so forth. Okay, that's weird. Okay, all right, so now we are doing the adjusting entry. You remember we did the accrual on that note before. So just as a reminder, we have the notes receivable, not the trade one, but this is with the supplier. So here's we lent the money to the supplier. This was April 31st of this year. We did an adjusting entry for interest because we had $3,000 at 4%. Now we've held the note for the last 6 months. So if we do the math again, it's 3,000 times, whoops, I'll start that again and make sure I've got the right things. The note itself is 3,000 at 4%. Let's make sure. I know we had two different interest rates going. Okay, so 3,000 times 0.04 times 6 over 12. So we got a 6-month period, $60. Okay. So I'm going to pick up 60, not 30, but 60. It's a longer period of time. So interest receivable and interest revenue. And we've done the impact on the statements before, so we're not going to worry about that. But I think I haven't done some of my postings. So let's see. I know I did the 18,000. Receivable from credit card company for $14,250. I didn't do. And credit card expense was $900. Okay, and service revenue was $15. And we actually had a space there. I'll stick it right there. Okay, and then we collected $14,250. So cash is going to go up, and credit card receivable is going to go down. So that's collected and zeroed. And we just accrued the interest. So interest receivable and interest revenue, 60, and interest receivable is 60. Okay. And nothing to the subsidiary ledger. Okay, so we're almost through. This time with the bad debts, we kind of looked back and realized that we didn't estimate enough. Maybe this isn't the best approach. So now we're going to try to use the balance sheet approach as a percentage of accounts receivable. Now, many companies would probably do an aging where they look at the subsidiary ledger and they see how many people are not past due and how many people are past due. And the further past due, the more likelihood that they will not collect. But we don't have enough people to do that. So we're just going to say we're going to focus now on the ending balance of accounts receivable. And we're going to jack up the percentage and say 25%. And that's kind of high. So if that really is what we're projecting, we need to work on our way of granting credit or our follow-up, because we're probably not doing as good a job as we need to do. That's too much to lose. But That's what I picked. So let's go ahead and use that. So I need to figure out what accounts receivable is. There's two things I need to figure out. I need to figure out the ending balance for accounts receivable. And I'm not going to go through all the calculations with you. I know you don't want to see me add all this up. I did this before. I'm just double checking my numbers. But I think if you do this, your ending balance would actually be $12,000. So you just have to trust me on this one. So I'm not sure. Sometimes my math is not the best. And then the allowance account, interestingly enough, has an $1,100 debit balance. Okay, and it's okay. It could be either a debit or credit balance. This tells me at this point in time I've written off more than I've estimated. But we are at the end of the period, and so that's not uncommon to have that. But that's not the kind of balance we want. So we're going to use these two balances to try to help us figure out what we should project for bad debts at the end of this 6-month period. So we need to figure out 25% of the ending balance for accounts receivable. So if I put in 12,000 times 0.25, $3,000 is my projection of what I think will not be collected. I need to get that $3,000 not just as a journal entry. What I really need this to be is the $3,000 to be on the credit side of the allowance account. It really should be a contra account has a credit balance if it's a contra asset. So how the heck do you go from $1,100 debit to a $3,000 credit balance? Well, what we're actually going to have to do in this case is so we wrote off too much. We underestimated, which we already said the first year's method didn't work the best. So we take that balance and we actually add it to what the balance is we want. If it doesn't seem right, we'll put the numbers in and it'll prove it. It'll actually give us, hopefully, the last time I checked, it'll give us the 3,000 balance we want. So 4,100 is going to be the number we use here somewhere. Let's see, 4,100. And we're going to put the same titles in. So again, this is the one that makes a difference. Bad debt expense. That has a real impact on the statements, and allowance for bad debts. Again, we've done the impact already on the statements. So bad debt expense we post for 4,100 is right. Well, where did it go? There. That's right. I kind of smushed it there a little bit. That's okay. So there's the bad debt expense, and yeah, the other balance was in there, but I got overlapped a little bit. But anyway, but the focus I want to show you is really on this side anyway. So 4,100 is credited to the allowance account. And that's, yeah, okay. So I'm going to take away the previous balance for a minute. And so now we're creating another balance, which I'll just have to, I know what I'll do here. I'll just put NR for notes receivable. So what is the ending balance to the allowance account? Okay, let's prove it. Because we know what it should be, so let's see if it actually worked. Hopefully. So if I take, it's a normal credit balance. I'm going to start with the credit side. 500 on the credit side, plus 1,900, plus 4,100. Whoops, darn it. Try it again. 500 plus 19 plus 4,100. And then minus 500 minus 3,000. Okay, there's the 3,000 we said we should have. That was what we calculated as a percent of accounts receivable. That's what we would have calculated if we'd done an aging. So when you're finished, when you do the balance sheet approach, you got to make sure that your projection of bad debts is in fact, the uncollectible amount is in fact the ending balance of the allowance. And the problem with it is normally it has a beginning balance. So you can't just take the entry, the calculation, and become the entry. Okay, so we pull that off, I think, hopefully. And The only thing we're going to take a look at this point is usually you close the books at the end of the year and you do all the usual closings, and I wasn't going to put all this on here, but assume that we did close the books and so all the temporary accounts are gone. Maybe, I tell you what, maybe before we close the books, let me pull out my stickies, which I apparently, oh good, they're all here. So as far, we can take that one off. Hopefully, yeah. So as far as the statements go, let me scroll this up so we can actually see the accounts we want. The balance sheet, the new accounts are, of course, accounts receivable is not a new accounts, but accounts receivable will be presented under assets, and then you're going to have your allowance account. I should have moved that over a little bit. So what I just want to show you is with the new method, we've got net realizable value. You don't have to label it on the statement, but I'm going to show it anyway. We think we're going to collect $9,000. We think we're not going to collect $3,000. So we are presenting a lot more information by having a contra account. Otherwise, we would just show accounts receivable at $9,000. But conservatism comes in here because before we learned this, we showed accounts receivable at the full $12,000. Now we realize that a better choice is what we think we're going to collect. It's a smaller amount, so again, we're picking the lower of two figures. Also in this section, we have interest receivable. I'll just type it in. And abbreviate it, and I guess it really doesn't matter what the amount is. I think we've got 80 at this point. And we have notes receivable, and whatever that was, I won't worry about the amount, but these are all new accounts. Allowance account, interest receivable, notes receivable are new for the balance sheet. We don't have any new liabilities, and there's no new stockholders' equity. So I'll leave that alone. And then as far as the income statement goes, whether we worry about, let's not worry about balances, we'll just put the account titles. So bad debt expense is not other revenue and expense on the multiple step income statement. It's actually operating expenses. And credit card expense is also an operating expense. So those are new, and then under other, we would have interest revenue. As it's not our major source of revenue, it's a minor source from, well, unless we were a bank or something, that would be different. But, you know, we extended credit for a customer, we lent a little bit of money to a supplier, so again, it's not, our main purpose is providing a service. So I think those are all the new accounts, because that'll disappear, that we have. Oh, the credit card receivable. I forgot that guy. So credit card receivable would be under here too. So you can see we have a number of new asset accounts. We could have, most of them are current, but we could have a long-term notes receivable. And then, of course, on the balance, on the income statement, we have a number of new operating expenses and interest revenue. So thanks for bearing with me. I know this was a rather long clip, but hopefully this will give you enough background about receivables.